Good afternoon. Welcome back to Your Money Matters. I am Angela Giroux, publisher of the Bauman Letter. And if you'd like more details about the Bauman Letter, please click the link above. There's also a link below, and you can get all the details, everything that's included in membership. And of course, it's all risk-free. Now, since we are headed into a new year, we are well into December now. We thought we'd take a little bit of a peek ahead. Now, we know this last year or so, really since spring, has been more pronounced, this very uneven market that we've been seeing. And we looked at a chart last week. I'd like to take a look at it again. And you can see just how the gains have been concentrated in just the big stocks. This is the NASDAQ, but I don't imagine the S&P looks too different from this. But lately, there's talk that things may be different heading into next year. In fact, not just different, but we might see a complete reversal of what we've been seeing. So let's take a look at another chart here. It is nice and color-coded for the holidays, so enjoy that. But you can see these big blocks of red: Microsoft, Apple, Google, down, down, down. And then you see these tiny little stocks all in green. So it looks like this reversal is already happening. So Clint, if this trend does continue, how do we position ourselves?
Let's talk about what's happened this week, because for a while now, we've talked about how just a handful of stocks are propping up the overall market. And just this week, I mean, it's becoming even more pronounced. So the first chart I want to show, this comes from Bespoke. And this is from earlier in the week, but it shows different stock market indexes and where they're at from their highs versus what the average stock within that index is experiencing. So here's that chart, starting with the left. So to walk you through this, starting with the NASDAQ composites, this is just the overall NASDAQ. Earlier this week was only 3.6% off its high. That's the lighter red shaded bar. Meanwhile, when you look at the average stock, where it's at from its 52-week high, so over the past year, a drawdown of almost or just over 39%. And you can see this kind of across the board. That's the most extreme example on here. But if you look at the larger names in the NASDAQ, like the NASDAQ 100, it's only 2.5% off its high, but the average drawdown of stocks within that, almost 17%. S&P, you can see, was trading just below its all-time high, but the average stock within the index down almost 12%. And then all the way on the right, I'll highlight small caps with the S&P Small Cap 600 index, 6.1% off its high at the index level, but the average stock down 22%. So a lot of stocks across the board, on average, hitting are already in bear market territory. And like I said, this has only gotten worse this week. I would actually want to show a chart I used last week just to show you what's been going on here recently. So this is the S&P 500 is the blue line on here, and the black line is the percent of stocks above their 100-day moving average. So that's just a good way to gauge how many stocks are above or below kind of this intermediate term measure of trend. And look at what's happened just recently, since really the start of November. So at the start of November, as I'm highlighting with the arrows on here, when you had the S&P 500 at a new high, you had this gauge on here, the percent of stocks above their 100-day. It wasn't anywhere near where it was at the start of the year, but it had recovered and it got back over that 60% level. But look at what's happened just this past week. You've had this sharp rebound, or actually not the past week, but since the start of December, you've had the sharp rebound in the S&P 500 back to new highs. But look at this black line on here. It is barely recovered at all and is sitting right around a 36% level right now. So it just goes to show that this issue with a few stocks propping up the market this year has gotten even worse just over the last 2 weeks. But this is creating some challenges, but this is creating some opportunities as well. So the challenge is, with what you're showing on that heat map earlier, if you start to see those big stocks start to come under pressure, start to roll over, that's going to be big trouble for the indexes because of how much now they make up of those indexes. But at the same time, with the drawdowns that we've seen in stocks underneath the hood, that's creating some opportunities. It's creating some really big valuation spreads. And here's a couple charts to illustrate that. So this one shows the 12-month forward PE, so using forward earnings estimates For the IT sector is the red line on here, and the black line is the market overall, but the blue line is value PE. And so you can see how wide the spread has become. I mean, you look at the blue line and it's still trading at levels that we were seeing back in 2015, 2016, 2017. Meanwhile, what's really made the market's PE take off is what's been happening and some of those large cap stocks, especially in the IT sector. And now this isn't just something we're seeing in IT. It's not something we're just seeing here domestically. It's a global issue here as well. So here's the last chart I want to show. This comes from AQR, and this takes a market neutral or an industry neutral value portfolio, and looks at the valuation spread between the cheapest and the most expensive stocks. And like I said, this is a global portfolio. It's about 70% developed, 30% allocated to emerging markets. The valuation measures include things like book yield, earnings yield, and so on. But you can see we are hitting levels that easily surpass what we saw back in the tech bubble. So once again, just illustrating that valuation spread between really expensive stocks and really cheap stocks. And like I said, that's creating some challenges and opportunities, because of how much of the indexes of those expensive stocks make up versus the opportunities you can start to find now among cheap stocks.
And speaking of those opportunities, Ted, obviously anytime you see any kind of rotation in the market, there's going to be some winners and there's going to be some losers. So who do you think those likely winners and losers are going to be?
Well, before answering that question directly, I think, the unfortunate fact is that the losers are probably going to lose more than the winners win. And that's why we see a lot of people saying, that the average gain for the stock market, U.S. stock market over the next couple of years is likely to be a lot lower than it has been in the past. And that it's going to reflect this, diminishing importance of these high valuation firms. But let's just show a chart that shows how extreme it's got. This chart shows the valuation dispersion between the 20th and 80th percentile of S&P 500 stocks. And essentially that big gray blob shows you the spread, the valuation spread, how far apart those two different groups of stocks are. And we've got to the point where the current valuation spread is more than double the long-term 25-year average. We haven't seen anything like this since the dot-com bust. Now that's not to say that we're headed for another dot-com bust, but it just shows you that what happened after the dot-com bust was that those big valuations came down, but it didn't necessarily mean that other valuations came up to replace them. So the first message is get used to smaller returns. It's just that's the way it's going to be. Now here's another chart that shows the tech sector. Again, it's part of that same package that Clint showed, and it shows what's really important here is that it's not earnings growth. There has been some earnings growth since the pandemic started in some of these big ticket companies, the Googles, the Alphabets, those kind of companies. But the critical thing is price to earnings expansion. So that's the red line. That's showing you that what's really happened is that people have been willing to pay more and more for a dollar of earnings of these companies. The critical thing to look at here is that red line is still going up, or it has still been going up until recently. But the trailing earnings per share is actually starting to fall. So you're getting an even bigger gap between what people are willing to pay for a company's stock and those earnings. Now, here's another couple of charts that illustrate this in a different way, but it's quite striking. If you look at the weight of the top 10 stocks in the S&P 500, as a percentage market capitalization, we're basically in uncharted territory. At the end of November, it was over 30%. If you look at the earnings contribution of the top 10, it was also quite high, but it's starting to fall. So eventually gravity's got to catch up with these top companies. I mean, you can't have a situation where their relative earnings growth is declining and their stock prices is rising. So they got to come down. So here's another chart that shows the FANGs. This is an exchange traded note called FNGS. And it shows that's the blue area, and it shows it's in comparison to the red line, which is the S&P 500. So what I've highlighted on the right is the big gap that's opened up between the FANGs and the market in recent weeks. Down at the bottom, you'll see that that's on the basis of relatively lower trading volume. So it's not like there's big sell-offs. It's just like that people are not enthusiastic about these stocks anymore. And then finally, at the bottom, Clint's favorite measure, MACD, we're solidly in pretty negative territory. I would argue that we're probably going to head even lower on that. So they're getting oversold. The question is, where's the opportunity? So one more chart on this before I show you a table. This is a chart that shows the S&P in red. It shows, again, FNGS, which is a proxy for the big FANG stocks, in blue. It shows IWO, which is small cap growth stocks, in orange. And then importantly, it shows cash cows. In other words, companies that generate a lot of free cash flow, which, as you know, is one of my favorites. I mean, basically, this is over a year to date. There's just no comparison. You can see that both the high growth small cap stocks have really fallen off a cliff since the beginning of November. So have the FANGs. The market continues to try to go up, but look at the outperformance. I mean, basically, that is quality companies that produce lots of cash. Now, here's a table that shows the relative valuations of these types of firms. On every measure, the cash cows, and that's an ETF called COWS, COWZ. And on every measure, whether it's price to earnings, price to book, the only one where COWS is a little more expensive is in price to sales. That doesn't worry me too much because it's still a very low number. But look at price to cash flow, right? I mean, basically, people are willing to pay huge amounts of money for cash flow that is inferior to other companies. And eventually that's got to catch up to them. I've highlighted in yellow just this enormous difference between price to sales and price to cash flow, both for IWO and for FNGS. And what that tells us is that although sales are continuing to grow, cash flow is not growing as rapidly, and that's because input costs are rising. So these companies' margins are starting to get squeezed. That's what this is all about. The next chart shows just the last 4 weeks, just to amplify this. Again, you're seeing a big decline in the FANGs, but you're seeing that the cash cows, the companies that deliver lots of actual cash flow, are rising and are really at this point just starting to outdo the market as a whole. The last thing I want to show you is that this is not the first time this has happened. Here's what happened after the dot-com bubble collapsed. And what it showed was that the companies that were undervalued outperformed very significantly, almost by 40% difference over the next couple of years compared to the S&P 500. So it's not like everything went down when the bubble popped. A lot of companies went back up. The point is that they're probably not going to go up by as much as these other companies have gone down, which leads to a couple of different recommendations. I'll start with mine, and then Clint can jump in as well. The first thing is, if we are expecting a big rotation, it's probably a good idea to increase your cash position so that you can take advantage of this rotation. You can start moving into some of the stocks. And a good way to do that would be to start taking profits on those companies that have become overextended. I mean, like, for example, I think if I held Apple right now, I'd probably sell a big chunk of it, take the money, the profits that I made, put it on the sidelines until we get some clarity as to exactly which companies are going to start rising. But I do think that that's going to be mainly defensives and companies that generate good cash flow. So here's a chart that shows what happened basically over the last 20 years. Whenever the Fed raised its fund rate, which is really what's driving a lot of this, the biggest 12 months gain after the Fed raised its interest rates came in REITs, which are the classic example, my favorite example, of cash producing companies. And particularly in an inflationary environment where you have a lot of these companies able to raise rents, triple net lease rents and things like that above the rate of inflation, or at least to cope with it, that's what you want. So that's certainly where I'm looking to put my money.
And Clint, what about you?
Yeah, what I would look at right now is what I was showing with that first chart. Go look at those stocks that have been taking a hit this year and start to build out a shopping list. Because, I mean, look, we could still see some more selling pressure in those names just over the next couple of weeks as people are tax loss harvesting, as that's coming into play. But a lot of times what you see is, those stocks that have done the worst over the past year tend to have a really good start to the subsequent year in 2022. So that's where I would be looking, across these indexes to look at where to deploy some of that cash if you've been raising cash to start the year.
Yeah. Just one caveat I'll just add to that. When you do that, don't just look at price. Make sure you look at potential earnings growth and if they're making money, margin growth. Because again, the market is shifting to a position where it's rewarding companies that are starting to generate actual earnings. They're not going to reward, speculative, what might happen in 10 years time. That they want companies that are growing fast now. So look for the small ones, look for the ones people are ignoring.
Or let Ted do all the hard work for you and join the Bauman Letter. Again, there's a link above with more details. I'm sure he'd be happy to help you. Thank you so much for watching, Ted and Clint. I'll see you next week.